Hey everybody, it's Erik, co-founder, partner of Village Global, a network-driven venture firm. And this is Venture Stories, a podcast covering topics relating to tech and business with world-leading experts. Hey everybody, welcome to another episode of Village Global's Venture Stories. I'm here today joined by a very special returning guest, Anuj Abrol. Anuj was previously chief of staff at Atrium with Justin Kan, and now is started Witty Wealth. Anuj, welcome back to the podcast.
I'm excited to be here. It's been a year.
Yes, absolutely. So Anuj, but by way of introduction, why don't you talk about what Witty Wealth is and what you're trying to accomplish with it? Obviously, before you came on, we did an episode with Keith Raboy. We did an episode with Justin Kan. We did this brief deep dive on evaluating markets. And now you're sort of taking that same sort of analytical rigor, public tech investing and public investing more broadly. Why don't you talk about what you're trying to achieve?
Yeah. So Witty Wealth is a community that helps tech stock investors build confidence in their own abilities. So for me, why did I want to do this? So we went on this deep dive for venture capital, how to evaluate startups. Like what differentiates, the ones that are going to be great versus the ones that aren't. And I looked at like tech stock investing, like how just hobbyists like be looking at these stocks all the time. And I just wanted to understand, can I play venture capital in the public markets? Like what are the things that are actually worth paying attention to now versus over the arc of time? And I just felt like nothing out there was really helping me. Either stuff was like really boring and dry and overly complicated, or things like didn't necessarily explain stuff well. And they were like too high level. So I wanted to do something that just for me, or like at least for someone like me, who's sort of a futurist, likes tech stocks, and wants to be educated in the bets that they make.
Totally. What are some of the topics you've gone deep on early in the Witty Wealth journey?
Yeah. For me, the one that we're going to get into is a lot about this thing called a special purpose acquisition company or corporation, or I need to probably edit that out. But for me, the first one is SPACs, which is what we're going to get into. But then I've been doing a lot of like bull case, bear cases on, at least at a high level on, different types of companies. So like Zoom, Slack, Peloton, and now starting this week or starting Monday, after we record this, I'm going to do an experiment where I'm trying to make investing a multiplayer game. So we're going to like deep dive on a certain company, do, bull case, bear case, and then sort of figure out as a community, what do we want to invest in? And then I have a pot of money that we're just going to invest in it and see how it goes over time. And paying attention to it.
That's awesome. It is interesting to see just how sort of Robinhood activity and just public stock investing activity has surged, especially among young people over sort of it seems since COVID. How do you explain that?
Yeah, I think a mix of things. One is you get the stimulus check from the government. Two, there's no sports going on, so there's nothing for people to bet on. Or they're just like nothing for people to entertain themselves. So you're sitting around all day, you have this chunk of change. The thing that changes all the time is the markets, at least from 9 a.m. to 4:30 p.m. So what else is there to do, which is really cool. And things are like very volatile. So things are changing all the time. So you have this constant, entertainment going on, or things to talk about, or things to react to, which just gives you dopamine hits, that compound.
Yeah. And Dave Portnoy, the Barstool founder, seems to have just hit a cultural resonance around, I guess making stock investing like sports with sort of all the competition, but also like silliness that is involved there.
He is, yes, definitely like been the symbol of this whole like change. Yeah. Whereas obviously Wall Street Bets was taking off, but he's essentially Wall Street Bets personified. And I guess for people listening who may or may not know Dave Portnoy, what he's been doing is he live streams his day trading every day, and he essentially just does like random one. He like boasts himself like, I'm better than Warren Buffett, because it's been this crazy bull market and his returns have actually been better than Warren Buffett in this short period of time. But two, he even just does like crazy stuff. So at one point in time, he keeps on saying stocks only go up. So he was at one point in time like just pulling Scrabble letters out of a bag and trading on those. And I think he actually did well. So and he's definitely made it entertaining. He's been the personality that makes everything entertaining.
Did he coin stonks, or what are stonks?
Stonks is just like a meme of stocks. Yeah. I think it actually didn't necessarily come across as like a meme about stocks. It was just like oh, I did something educated. And like, maybe you weren't necessarily educated, but it's just like, oh, look at me, I know stonks. And then it's like this guy who's dressed up in a suit. But yeah, stonks is, essentially become like this meme that's been associated now with all this parody of craziness.
Yeah. Let's do a deep dive on SPACs, and then we'll return to some other topics here. For people who may not be familiar, why don't you do this sort of explain like 5 version of SPACs and why they matter?
Yeah. So a SPAC is a new type of company, or a blank check company that's essentially a publicly listed pool of money. And their goal is to buy a company or merge or acquire a business within 18 to 24 months. So think about it like they're a blank check search fund in a way. And before they buy the company, they go public themselves. So really it's just like a sponsor who's attached, who's like, hey, Erik, you have a SPAC. You're essentially this publicly listed pool of money now on the stock market. And then you want to buy something, within 18 to 24 months. Yeah, that's I guess the main part.
What's innovative here, or what's important about it, or what are the implications of it?
Yeah, so with a SPAC, I guess there's 2 main things. One, the types of companies that a SPAC can buy, because they essentially go through public firsthand, then the companies that they buy can be more forward-looking. Essentially, these are businesses that that are expected to have revenues in the future, but they might not have revenues right now. So they're very forward-looking type businesses, which is one. And then 2, what's interesting is then you as an investor or a casual investor can invest in these companies in the public markets. Whereas before, only if you're a venture capitalist or angel investor, you had access to these types of deals. When they were private companies, could you get the opportunity to invest before they necessarily grew or popped off.
Like, what is talk about the alternative to SPACs, and then maybe we can get into sort of the pros and cons, or the debates that we're having between them.
Yeah. So when you say pros or cons, I guess I'm curious from like what point of view or are you thinking about?
Yeah, just the various different stakeholders. They're just sort of the pro SPAC argument and the anti SPAC argument. Yeah.
So I ended up doing a couple articles on SPACs the past week because I myself is just trying to understand like what is, what are they? What do they mean? What do they mean for me as an investor? And the SPACs are pretty interesting because from I think March to May of 2020, actually more SPACs IPO'd than a traditional company IPO. And I think the reason why comes down to it's better on a couple different dimensions for each of the main stakeholders. So I can give maybe a 2 to 5 minute spiel on, what the takeaways are. But
please,
if you're a SPAC, essentially you are this, I guess there's 3 main stakeholders, right? One is you're this sponsoring investor who initially brings this blank check pool of money to the table, right? And if you're them, essentially what they do is when they go public, then a bunch of different other investors like you and me could invest into the SPAC. So it gives the SPAC more money to buy bigger companies. So it gives the sponsoring investor more leverage. So for example, it's sort of like an AngelList syndicate, but public in a way. And the only downside is, say they don't find a company within that 18 to 24 months, or the company that you want to acquire, it has to be voted through by your shareholders. If that doesn't get voted through, you just get your money back. So it's essentially you're just parking your money in a bank account anyway, and there's little downside. And then also with that, the upside, if you're a sponsoring investor, if the deal goes through, you have essentially an optionality where you can get 20% of the SPAC for almost free at the end of the day. So huge upside for the investor, or at least the sponsoring investor. And the second one is the bank, at least at the beginning. So to bring the SPAC public, so traditionally for an IPO or traditional IPO, you get 3 to 7%. The bank gets 3 to 7% of the amount that's for sale. But for a SPAC, what's pretty cool is they still get essentially at the end of the day around 5.5%, and then plus more. At least that's what someone told me on Twitter, because there's a whole associated fee. So the banks can also make out pretty well. And then the third thing, I guess most importantly, is for the company. Because I believe at the end of the day, the company is the one who's going to be able to decide. And in times like what we end up seeing in like this March through May timeframe, and even now, just tons of volatility. So what you end up seeing beforehand is with a traditional IPO, like for example with WeWork, when they wanted to go public, right? Like people read in the S1, they didn't like it, they got spooked, they didn't go public. But now what's happening is like, instead of having to get buy-in of the general public, you really just need to get buy-in of the stakeholder to bring you public. And when things are volatile, and companies are like, okay, I can get a sure bet. I know how much money I'm going to get. I know that I'm going to go public. So rather than just negotiate with the SPAC for them to either merge or acquire with me to take myself public.
Yeah.
So that's one thing. And then there's other stuff around, like, you understand the price way up front versus understanding on IPO day or what maybe the day before what you're going to be priced at, and then it's essentially so you get information up front, and then the first part is quicker because it's already taken care of by the SPAC before you get acquired.
Yeah. And so what about people who prefer sort of a traditional IPO?
I guess there are pros and cons to it. I think this is where I had this Twitter thread that ended up going on in the discussion. But essentially, I think it comes down to two things. One, or at least it comes down to a couple things. So one is mainly price. So this concept of people who are very pro-SPAC, they're saying like, okay, when you have this IPO pop, you as the company and your shareholders, your employees and your investors, you get diluted, right? That was money that was on the table, that was left, that you left on the table, and they end up arbitraging. Because within a one-day pop, if it happened, 50, 100%, that's just money you give away for free, and in theory, no value is created. Or at least that's the perception. But on the other side, people who love the IPO are like, no, actually, this is part of a market-making function. The IPO supports your downside risk of what you, as a SPAC, need to, like, sometimes SPACs don't pop, right? But as a bank, they provide that support for you in the event that doesn't happen.
Yeah. What's the why now for SPACs?
Yeah, one is, so SPACs actually came around in like 1992. So I'm going down this big rabbit hole of SPACs and essentially like the legislation that happened around it. And before, blank check companies, before 1992, so actually in the late 80s, they were using like these pump and dump scams. So these blank check companies weren't necessarily on the stock market. And if you think back then, like, people would just hop on the phone. They would say like, hey, I have this great opportunity. Are you in? And it'd be a largely unregulated market. And so then in 1992, or over the years, a bunch of different regulations happened. And in 1992, a SPAC formed. But now, essentially, the main thing is volatility that we end up seeing. And SPACs do rise in popularity whenever we're entering like either a volatile time or in like sort of a recessionary time. So after the IPO boom or the dot-com boom, this happened. So like in 2003, 2004. And then also post like the banking crisis, things started to pop up too. But now this is more or less a sign of volatility. And I think also we live in like this ultra low yield period of time where essentially like the bank rates are essentially zero. So why not just invest in these forward looking companies that can impact the future? And SPACs are a vehicle to bring them public.
Did Chamath, single-handedly bring the SPAC back, or what's sort of his contribution? You had a separate blog post about him generally.
Yeah, so I'm just naturally inspired by Chamath as an investor, but so he brought at least to tech circles, he sort of revived the SPAC, or he's considered as a SPAC revivalist. So in 2017, he had a SPAC which was the ticker was IPOA, and essentially it was just trying to buy, I'm not sure the exact verbiage, but buy a company that they thought could be transformative to society and also be a good business. And at the end, near the end of his 2-year time frame, they end up merging with Virgin Galactic, and he was the first one to do it from like a tech stock perspective. And he's considered like the SPAC leader, especially if you see anyone talk about tech and SPACs on Twitter, they always just tag him.
Yeah. And what does the SPAC have to prove, do you think, or what are the big questions over the next few years that we'll sort of see with SPACs to see if they really sort of take off?
Yeah, so SPACs, for me, actually, one thing I'm concerned about SPACs, well, I think they can be a great vehicle for the future if they're used correctly. They're also used right now, or at least a lot of the discussion around them right now is for arbitrage opportunities. So I've been spending a lot of time in online communities that talk about SPACs, and it reminds me a lot of cryptomania. So especially like shades of like fall 2017 when crypto was popping off, you had blockchain enabled, a lot of these different crypto companies to, transact money or just paint a picture of the future, which is very inspiring and people wanted to buy into. and you had a whole flurry of ICOs. And I think like 80% of these ICOs, at least in 2017, were found to be scams. And with SPACs, you're starting to see some similar shades, especially I think I saw this stat like over 70% of SPACs lose money or like now trade at a lower price post the M&A that end up going through. And we talked about earlier, as a sponsoring investor, you can get 20% essentially of the SPAC if the M&A goes through for free. So you have a lot of incentive to just buy something as the deadline gets near. And for me, just getting back to your question, like what are the things to look out for? I'm curious to see, like, will there be a whole flurry of fraud that pops up? Like, it's very frothy and exciting right now, but 2, how long will that last? And then 3, like, will it just end up being something that's considered like now, like ICO sort of has like this negative connotation to it. Will that be the same case here too?
Yeah.
Those are things I'm curious to see how it all plays out.
What do you think is the biggest misconception sort of people, smart people have around SPACs? Or what do they not fully appreciate, you think?
Good question. I think there's smart people in all. I guess I don't know if it's necessarily about smart people per se. I think it just depends on your point of view. So when now I actually live in Michigan now, and a lot of the investors who I talk to don't necessarily get access to these types of deals, right? They want to invest in the future. They want to be like allocate some portion of their equity or money to buying into these companies. But why SPACs are great, why they're viewed as great, is like, I want to fund the future too. Like, why do people in Silicon Valley only get access to, helping support a space tourism company? Why can't I do that? So I think for a lot of America, they're excited because it gives them an opportunity, or people who invest in the stock market, it gives them an opportunity essentially to get access to like these VC type deals that they want to support and be part of too. Yeah. I think in general, people who are in the industry are more critics of like, these things are dangerous and like they need to be used correctly.
Yeah. And even before sort of SPAC mania, there was, a lot of conversation about the IPO and sort of how there were challenges with the IPO, Bill Gurley and others, and they were comparing it to the direct listing. Talk about or unpack that conversation a little bit. What concerns did people have around the IPO, and how did that compare? And then unpack the direct listing and the pros and cons between the two.
Yeah, so I can give you my point of view from my understanding, like just trying to understand what the internet says. That said, I'm not like a financial advisor or a banker, so I can't necessarily say I'm sure someone can give a better perspective. But so I guess my understanding from what Bill Gurley is critical of is there essentially of this pop that happens. So for either he as an investor or the founder he backs or the founder's employees, they essentially lose a lot of money, or they lose money by having this pop occur. Because what happens is they sell their shares to the bank at a certain price. And then when the pop happens, essentially like the bank, whoever the bank sold their shares to or what they did with their shares, now trade instantly higher, a day or two later. So it's not necessarily an efficient function for the original sale of shares. So he's very excited about a direct listing, where it's essentially like an auction, right? Where someone who, like literally whoever is willing to pay the highest price is going to, or, it's a more efficient way of pricing. And in theory, his clients will get the most accurate price, or his founders will get the most accurate price, or even the highest price when they decide to go public.
How do you compare, again, let's compare the direct listing and the SPAC. Yeah,
so a direct listing, the main thing about that is like you as a company, essentially you're selling your own shares, or like your employees or whoever has shares, they can sell them. You're not necessarily raising new capital for your business, right? Versus an IPO you are, and in the SPAC you're getting M&A, which essentially you're acquiring new capital as well. So in theory, I guess I can lay out a spectrum. So in terms of like how I view it, the most efficient pricing is in theory this direct listing, if you think about it, like all the way on the left. And then in the middle you have the SPAC, and why I guess some people view it's more efficient is because it's a direct negotiation that the company has to do with their acquirer. And then it's very clear and transparent in terms of what the price is going to be, and that upfront before you have to go through this whole process. And on the far right is what I guess what you would end up saying being, an IPO where you, the company, have less control over what the price is going to be. And then pricing happens at the very end when you're sort of already in this process and you're already set to go public.
With the SPAC mania, why is it so controversial? What are people fighting about on the internet?
I think there's two camps. So you have like the probably like the Fin Twitter camp, who's more like talking about whether or not this is better than an IPO or not. And then you have another camp, which is more like these casual investors who you probably like, who maybe they're in a Facebook group and they post like, what should I buy today? That type of investor who's more of a pure speculator or better, or they don't necessarily have access to financial advice. And I'm not financial advice either, but essentially they're just like, they fight about like whether or not this is fraud. So for example, with a SPAC, I guess with the latter camp, with a SPAC, you're buying something that's saying like, oh, I'm going to have revenues of this much in 2024, or like, a couple of years from now. So it's just like a pure story. So think about it like when you're angel investing or you're, investing at like a seed or a Series A, you're buying into like the vision and the picture of the company, right? And that's what helps you get very excited. Versus when you're a public investor, you already, or like as the company evolves and matures, there's actual data that you can evaluate a company on, right? Versus, if you're a later stage or like now SPACs, they're like, you can essentially, the only types of like criteria you can evaluate a company on is its story. So essentially you're forced to play, VC in the public market here.
Totally. What did Alex Rampell and Chetan or Erik Vishra from Benchmark, can you unpack their argument that they had on Twitter the other day?
Yeah, so they're much smarter than me, but from my understanding, so Alex, he is saying that just because an IPO pops doesn't necessarily mean that it was inefficiently priced. So for example, if you think about it in terms of supply and demand, when a company needs to go public, a lot of people actually don't want to sell their shares. And so there's a limited amount of supply, or which is called like the float. And or that's just like the number of shares essentially available for trade. And just because there's at the initial, IPO, just because there's a little amount, there's like people are very excited, there's a lot of demand and there's not as much supply. So there's naturally going to be, a high price and a lower quantity. And what he's saying, just because that's the case in the short term, doesn't necessarily mean that's going to happen over the arc of history. At least that's my understanding from his tweets. And then what I believe Erik is saying, well, that may be the case or may not be the case. I think it's sort of like people are talking like counterfactual, so it's not exactly clear. But essentially, I think what he's saying is that whether or not that's the case, that isn't necessarily an efficient way of pricing things.
It's interesting. I mean, I feel like a couple years ago, we were having sort of this debate or, argument over whether companies should go public sooner versus later. And now it seems the controversy is when they do go public, what is the vehicle by which they do so? Is that a fair way of do you think that debate over go public sooner versus later has been like, it's been decidedly one that you should, companies are just going public later and not thinking about going it sooner? We also see things like Eric Ries's long-term stock exchange, try to make it easier for companies to do that such that they want to go public sooner. How do you think about that?
Yeah, in terms of going public or not, I think for me, it's more just about personal preference. I think from, at least from my understanding of why people want companies to go public sooner, at least like why I think I've seen like Bill Gurley tweet about why he wants companies to go public sooner, is because it forces you to be honest, like about, because you have this quarterly reporting, right? So I think it sort of forces you to be honest about, how your business is, how healthy your business is now, like what's the direction that you're going into things, versus if you are private for longer, you can largely, it's more of like you're more accountable just in general to like the VCs on your board or, your bigger investors. So maybe they require you to be honest or not, but I think it's, that's more of like a one-to-one conversation. And then two, you also have like this general, I think like more people who take like the wealth inequality thesis. They're saying like, okay, if you're staying private for longer, that means a lot of the growth is not necessarily being captured by the everyday, American investor. is largely going to a venture capitalist who is funding these companies as they grow.
You could imagine a private company say, hey, we're not going to necessarily go public, but we are going to have quarterly reporting. That'd be interesting.
Yeah, I'm not sure what long-term stock exchange is up to, but that could be something as well.
Yeah. Let's say you're talking to a founder in your portfolio who's about to go public. Yeah, they're choosing between a SPAC, direct listing, or IPO. What would you advise them, or how should they think about
it? Yeah. Well, not if a financial advisor, and I'm also not an investment banker, but I think I can lay out like the pro-con case for each of the three options. So from my understanding, if you're like a healthy like business, or if you're a business that doesn't necessarily need to raise outside of capital, that's great for the direct listing, right? So you see that with Slack, you see that with Spotify per se. And if you are a business who you have like some sort of operating history already, or I guess maybe I'll go to the second one. So that's what a direct listing is. If you're a business that's like, you want to go public, but you don't necessarily have like previous operating history as much, and your business is more focused on the future. So for example, like if you're like Nikola Trucks and your trucks aren't going to be out for another 5 years, but you think going public can be a great source of capital and a good decision for you, then going via SPAC is a route to go, right? And then I'd say the latter, there's probably a whole host of reasons in terms of like IPOs, why they're more traditional model. I think there's a reason why that's the case. But I guess in this example, I would probably assume is like that's the catch-all for not wanting to go SPAC or direct listing route.
Yeah. Say more about what separates the good SPACs that perform well versus ones that don't. What is sort of the criteria?
Yeah. So with a SPAC, essentially when you're like this blank check, publicly listed pool of money, all you have attached to it is all you have is essentially the money and the sponsoring investor. So the money is money, it's a commodity at this point in time. But so really what you're doing is you're betting, can this sponsoring investor like buy a great company that essentially is going to make the value of this money grow, right? So essentially you're just investing in the sponsoring investor. And I did like a quick, analysis essentially on like there's where the SPACs have done the most well, and 3 of them so far, they end up buying. So one was Chamath's with his IPOA ended up like merging with Virgin Galactic. Second was this one called like Vecto IQ, and they ended up purchasing or merging with Nikola Trucks. And the last one was like Diamond Eagle, and they ended up buying or merging with DraftKings. And all 3 of them, essentially beforehand, the only thing that you could really rely on was the credibility of the sponsoring investor. And I think there's like 3 things that you want to look into. One, do they have essentially experience in the space, or like what the SPAC is exploring and like what types of companies they want to buy? 2, does the sponsoring investor have some sort of history in terms of like operating these companies? And then 3, do they have a history of like financing or raising money beforehand? So essentially they're a capital allocator, and you need to figure out, are they going to be a good capital allocator? And those are like just a couple rules of thumb that can use to differentiate whether or not someone's credible who's a sponsoring investor.
And what do you expect to write more about in the future on this topic? Where is your curiosity taking you next?
Yeah, in terms of SPACs, I think for me at like a high level, I have an understanding of what's going on, but there's a lot of mechanics. Like for example, like there's this Twitter debate that ended up happening in my thread, and I'm curious as to like understanding the mechanics. Why are things counterintuitive? Like for example, like Alex, he's saying just because there's a pop doesn't necessarily mean it's inefficient, and I think that's curious to understand why. I think SPACs, I'm sure, as like for example, when I see like crypto, how it evolved, you obviously had a lot of reporting how like things didn't necessarily work out, but there's probably stuff that did work out really well. And I'm just curious as to maybe there's certain avenues of where SPACs are better, or like there's certain things that. So for example, I guess so for me, where do I want to take my writing, at least in terms of SPACs? One is I want to understand the mechanics of things. So for example, like Alex in my Twitter thread, he was saying, just because things are popping doesn't necessarily mean that it's an inefficient market. So I'm curious to understand why. 2, I think there are certain areas that are more interesting, or like where SPACs can be more applied. So for example, like electric vehicles, right? Like Tesla, there's a lot of hype for Tesla right now. And then in turn, you have a couple like electric vehicle SPACs popping up. So you had Nikola with trucks, and you even have one that just got recently announced, like Apollo, was their SPAC was like merging or acquiring with Fisker, the electric car company from like the early 2013s. But that's a function of ESG investing, which essentially is like, we need to make sure our capital is going towards things that are, environmentally friendly. And I think that could be a case where you end up seeing a lot of money flooding into SPACs, specifically going into like that type of investing. So I'm curious to see how long those trends will play out.
Let's segue into other broader topics you've written about on public investing.
Yeah.
So let's go back to Chamath. Why do you really admire him as an investor, and what do you think he has unique insight on or superpower?
Yes. So Chamath, I think in general, is able to do two things, at least in terms of his demeanor and how he communicates. So one, he's able to sort of like call it, or as like a retail investor, you can see that he calls it for what it is. So he has this like unique, like bold, polarizing take. So for example, like he talked about like VC being a Ponzi scheme, right? Which is sort of like he was a VC at the time and essentially just called out his own entire industry, and then it's like, screw this, I'm not going to be a VC anymore, right? I am going to be, this like broader, I'm going to be like play the whole game. Two, what I like about him is that the way he's able to communicate things. So for example, he's just like straight into the point. There was something that got very popular around the time when like he was talking about should airlines get bailed out, and he essentially was like directly no, versus when you hear other investors, it's like very pandering, and they try and bring up all these different types of cases, when he just gets straight to the point. He speaks in a way that I feel like the average person can understand. He's been able to like break through. Or so I feel like other like investing figures. So for example, on like one end, like Warren Buffett, who's very smart, but naturally because the way he thinks, it comes across like very nuanced and detailed and layered. But to like the average person, doesn't necessarily. It's like sort of boring and dry. And on the other end, we talk about Dave Portnoy, who's just like very brash, sort of makes a mockery of things. And that's like more or less like what the average person understands. But you can sort of see through it. They're like, okay, this is, once this, party stops, he's going to probably go back to sports betting or something. It's going to get washed out. Whereas you feel like Chamath, he has like the intellectual capability of, Buffett, but he has this ability to speak and demeanor like Portnoy.
Yeah. And when he was talking about VC Ponzi scheme, his argument, if I understand it correctly, was that too much VC money is being used to prop up, basically, pay for Facebook and Google advertising.
Yeah, I think that's one part. So essentially, I think the main thing is, what is the incentive of the venture capitalist? At least is at least my interpretation of what he said. And it's like, my goal is to just raise another fund and raise a bigger fund. So what does that mean? Okay, I essentially I'm going to give this company money, and I need them to quickly show that they're growing in value, because then I can raise, so then they can raise money at a higher valuation. And then in theory, then I can go to my LPs and say, look, these companies are doing great. So let me get a markup, and I can then let me raise like an even bigger fund. And then as a venture capitalist, like your fee structure, the way you're making money is, I guess the stereotypical was like 2 and 20. So 2% of the money that's under capital and 20% of the profits. So you can at least for sure if you can grow the size of that fund, your 2% is essentially becoming, growth bigger and bigger each year. So then you have people who are essentially just trading off startups to each other. And in terms of like just backing each other's startups in a way that they can then go sell markups or get markups and sell it to their LPs to raise bigger and bigger funds.
Chamath is one of the bigger investors in Slack. Let's talk about Slack. You wrote about sort of the bull and bear case there.
Yeah. So Slack is right now it's also like a very polarizing company on FinTwitter. And I think the reason why is interesting. So, you and me, like I'm on deck Slack, and I see a lot of value in Slack, and I've used it at all the different startups that I've worked at. And the question is, can they become a big time company? And in terms of bull case, one is like their product is amazing, right? Like everyone who uses their product loves it. They have great like churn numbers, and there's a form of lock-in. And the question is, will they be able to beat out Microsoft, specifically Microsoft Teams? Like there's a lot of talk is on Microsoft offers like a Slack essentially version for free. Can they overcome Microsoft's distribution advantage? And the question, that's what is the debate hinges on. Can they do that?
Yeah. Totally. What are any other companies you've done the bull bear? Did you do Tesla?
We haven't done Tesla. I've tried to stick to companies that are, at least initially, like what's my sweet spot, right? It's companies I think have like IPO'd within the last 5 years and are largely like a singular product. So that's been Slack, it's been Peloton, and then that's also been Zoom are the three that I've done so far.
Let's do Peloton and then Zoom.
Yeah, Peloton. I think on all of these, I know we talked a little bit about like moats beforehand, not in this podcast, but we talked about with Keith. And essentially with Peloton, you have this great brand, you have this cult. But the question is, over time, can you like either one, grow this cult, or two, can you extract more value from this cult, right? Bull case for Peloton is essentially they built a great brand. They're essentially close to profitable. And then three, they have this ability where they have opportunity to like upsell into different products once you already have a Peloton cycle. But then two, the bear case is what's the moat? So you have this brand and you have this cult, but there's questions on can you grow this existing group of people you have? But two, where's the lock-in? So for example, like we talked about in our markets piece, like brand is essentially like a weak moat. But can you build a stronger moat, which is around like maybe social or network effects? Like for example, like if I was cycling, like now we're stuck inside and we used to work out together. We didn't, but if we did in this example, why can't you use some sort of like social ability to like work out with you? Or what are the lack of social features? And from my understanding, my perception is that Slack or Peloton has largely just dropped these social features and hadn't focused on it. So as an investor, you're like, okay, will this company will it endure over time?
Totally. And what's the next one you're going to do?
The next one I'm going to do is TBD. I'm working with a community. We're figuring out what's the company. And we're actually going to do, instead of just doing like this 1 day bull bear case, and we're actually going to do a longer, maybe it's like a 2-week type of thing where every day we go in depth. We try and make investing a team sport. So maybe it's, I like lay like, here's the initial like high level bull bear case. People can go deep on saying like, hey, here's what I think the bull case is. People can go deep saying, here's what I think the bear case is. We'll interview people who have like extreme opinions on either side. Yeah. And then at the end of the day, I have this money I'm just going to apply towards the decision, and other people can apply their own money too if they want. Obviously, they should talk to a financial advisor, and then we're just going to invest, or I'm going to invest some money and see where it goes on whatever position we take.
And you had a couple blog posts on Zoom, right?
Yes. So I did 2 blog posts on Zoom. So I guess in short, the bull case on Zoom is naturally they have an amazing product. It's so similar to Slack, right? And the main bear case is what's the moat? Or like, can they easily be wiped away? And so, for example, during COVID, essentially a lot of companies need to, instead of like actively evaluating what's the right tool for me to use for my conferencing software, they're just like, okay, Zoom, we already know Zoom, let's just buy it. We're working remotely. Let's like not even think about it right now. So there's, I think, 2 things that are going on. One is, will companies essentially reevaluate, what they've bought? Because there's not as much like lock-in essentially for Zoom. And then 2, the question that I guess also for Zoom is then what's the moat? And a lot of the talk, from my understanding from the moat, is just like a crazy hard technology to build. The question is, can someone else, competitor, build something that's good enough and that already has distribution and beat Zoom out? And then also as an investor, the question is like, how much growth is left and can it justify its valuation?
You also wrote a post on roboadvisors, and why don't you talk about that?
Yeah, so roboadvisors, it's more of like a raw thought. So with Witty, it's more just trying to get people to talk about stocks and make it a multiplayer game. So a lot of the things that I end up saying are just more at a high level and essentially casual riffs, as if you would have a conversation with like a buddy, when you're just hanging out. And the last one on roboadvisors. So whenever I talk to people, I did like 50 conversations this past month, like in depth with people who read Witty, and I want to understand what's like their investing goals, what's their approach, like what's their problems. And one of the things that I heard anecdotally was like when they talk about how I put part of my money in stocks, I put part of my money in index funds. I use a robo-advisor for my index funds, but I hate my robo-advisor. And I wanted to understand why. And for me, I use a robo-advisor. I signed up for Wealthfront like 5 years ago. And it's sort of like the product is built for you to sort of just like set it and forget it, right? Which is great in that aspect. And I haven't checked my Wealthfront in a long time, and I realized in hindsight, that ignorance was bliss. So with Wealthfront, or people particularly who use Wealthfront, a lot of my base do, because Wealthfront naturally targets tech savvy millennials. But first off is like returns. So Wealthfront, if you have over $100,000 in savings in Wealthfront, they automatically put your money into this thing called like a risk parity fund, or they put 20% of your money into a risk parity fund. And this is it's naturally designed, like people at Wealthfront are smart, right? And they want it to like smoothen your returns in terms of volatility. But, in the past few months, or like in 2020, things have been like very volatile. And their fund actually has like a negative like 13 or 15 or somewhere in that range percent return, right? And as of now, like the market is essentially flat. And the question is, okay, why is this, not doing well? And for me, I'm sitting on like at least year to date is a minus 4.5% loss, or almost 5% loss on my Wealthfront. So one is returns. People are just like, why is my returns much lower? Two, if you think about what was the initial pitch of Wealthfront, in mid 2015, they're like, why do you want to use a robo-advisor? It's largely like, okay, passive investing. So they'll put your money in index funds. You'll get market level returns. And, it's like a lot of times like the pitch, or like my understanding of the pitch was like, you're going to lose money by trying to pick stocks, right? So why not just put your money in index funds? And part of it is like, okay, now this risk parity fund is like, they're actively investing, or like people who are the customers I talk to, they view the risk parity fund as something that's actively investing. Wealthfront claims it's not a form of investing. And so users think it's like a loss of trust, or it's like, this breaks the consumer promise that I initially saw. And then third, it's it's sort of like largely dehumanizing. Like the people who follow Witty, they love to pick stocks. They believe in themselves, and like they want to become great investors. So naturally, like with a robo-advisor, you're putting yourself into a box, or like they want to understand your risk tolerance score, and Wealthfront puts you on a score of 0 to 10, and then they invest for you. So for someone who wants to be unique and wants to invest for themselves, naturally like that MO opposes who you are. So it's largely people view as dehumanizing. But overall, I think like part of Wealthfront, like I'm still a customer, and I think a diversified strategy is important. But that's just like a raw thought that I felt like people were talking about, or like kept bringing up to me as something I wanted to surface.
Yeah, it seems that we've been having this broader debate over active versus passive for a long time, both on like a personal level and institutional level. Do you have a take on that debate more broadly?
Yeah, I mean, I do believe that like if you want to maximize your returns in terms of amount of effort you do, just invest in index funds. Like that's my interpretation of like the literature I read. And obviously, again, I'm not a financial advisor, but there's an element too that I feel like people that like me and people that read Witty is that they like to pick stocks. It's whether or not they can get better, not better. Like the goal is to like let's achieve returns that are in line with the market, but it's something that's provides, like we talked about earlier on, like why is there so much activity in the market? It's good. It provides like your curiosity. It's something to do. It's something to talk about. So I think it depends on what your goals are. It should indicate whether or not what approach you should take.
We've been talking a lot about public investing. I want to spend a few minutes to talk about private investing. We did, but largely under your leadership, this sort of deep dive last year on evaluating markets, and it's called the Founder's Guide to Evaluating Markets. But of course, there are implications for private investors as well. Why don't you talk about some of the learnings there and how that influenced how you think about startup investing?
Yeah, no, this is a good retro. I mean, it's overdue, but from I think the point of view that we portrayed is as an investor, or like if you're a founder or you're an investor, there's, especially in the private markets, there's orders of magnitude level returns you can get that are differently, right? So if you think about people who are, for example, Facebook, you're returning multiple thousands of dollars on your initial investment versus something where like, I was involved in Atrium and we crashed and burned and we didn't return money we didn't return multiples of money to our investors. So largely the debate is how do you differentiate between startups that like before you invest or before you start one of these companies, how are you going to be able to differentiate between these types of opportunities? And the common like things that people talk about is like market, product, or team. Those are three different buckets that consist of a business. What market are you operating? What's the products that you're building? Or who are the team or the founders that you're going after? And essentially what we end up like from our research and our point of view, like we were like, okay, market is the most important thing. Like you can have a great market will pull the product out of the pull the product out of the business. And if you have a great market and it takes off, like from an investor point of view, investors, I think, I'm not sure who ended up saying this, but they're like, you can always replace the team. You can't necessarily later on change what market you're operating in. And then we end up going into a ton of criteria. I think the post is like really good and detailed, but might be not worth me going on a diatribe about right here.
Yeah, no, totally, definitely, check that out. Yeah, I think one of the more interesting things was the go-to-market, difference between the Peter Thiel approach of sort of owning a niche and expanding from there, and the Kiefer Boy approach from just taking a big $1 trillion market, sort of all at once.
I'm curious actually, because you've been private investing ever since we posted. I'm curious, has that affected the way you think about opportunities that you evaluate?
I think one of the ways is being able to just identify when a company is taking the Peter Thiel approach and trying to own a niche and expand it versus when they're taking the Kiefer Boy approach, and knowing on the Kiefer Boy approach, there's a whole criteria that comes with that. One of which is their ability to raise capital.
Yep.
And they're going to need to be able to raise a lot of capital. And there are others that we wrote about. And in the Peter Thiel approach of expanding the niche, there needs to be sort of niches to expand into. And I think sometimes people think, that there are adjacent markets when they're really sort of totally different markets. I think CRM is an interesting example. Like there's great opportunities for vertical players in CRM, like Viva in pharmaceutical companies, which built a multi-billion-dollar company just servicing that. But if you are focused on a vertical that isn't big enough in CRM, but you're saying, hey, we're going to expand into different ones, you might not be able to because they're just so different and require vertical specific solutions.
Yeah, no, that's awesome. Yeah, I still evaluate angel investments a lot, and it's something I question. Like that's like the main thing. I just focus on do I think this is a great market opportunity? And I think what I'm excited to do is we do these deep dives in public opportunities, especially if thinking about whether or not investing in essentially trying to play VC in public markets is, I guess, one way to think about it. Like what's the market that they're going after and how big can they get? And, all these things we talked about in the post. Yeah.
You have a couple posts on sort of memes and stock investing and how, it's just how reflexive stock investing is in general and, the hype cycles. And it seems that internet and social media and as stock investing gets more social, this would only amplify. How do you think about that?
I guess the question is, how do I think about using memes to communicate?
How do you interpret the role of memes in public investing and how that will amplify or not amplify?
I think so. Memes are great when you want to either communicate something it could be too long or wordy or is just maybe hard to describe, but two, they can just capture something that's crazy going on, right? So for example, my friends at Morning Brew, they have this really cool tweet on the Fed propping up the market. It's a crane who's just taking an airplane. They have an airplane, clamped down and the airplane just spinning around and around and around and around. It's the Fed propping up the market. But I think when times just keep on getting crazier, you're going to see more memes and they're going to get more popular because everyone sort of understands hey, what's going on right now? It just is deviate from reality and doesn't make sense. So things are going to be a parody. Why not just have fun with it and make memes? So I think you're at least, I guess what I'm saying is in terms of public markets, you probably see meme engagement correlate with stock market volatility. I guess is my galaxy brain analysis there.
That makes sense. What do you think about social money just in general? Why isn't there, what you're doing is really interesting with the 100K and getting to be fully transparent about it. Is there a platform that can enable that, you think?
That's a good question. I'm not 100% sure. I think so one way I think about it is, could you build an AngelList syndicates type of thing for public markets where or I guess there's two things I could see happening. And obviously this is like deviate from like regulations and things that I need to understand. But one, could you make investing a sport, right? Like you have like for example, like esports, you have like Ninja, or you have these different figureheads. Could you make like day traders who are actually like out there talking about stocks, and maybe they build up armies of followers, and if you want to, you can invest along, like people I know, like, or I see on Twitter, they like essentially like, you know, day trader, he makes a position, and then like his followers, like, I want to like understand, I want to have the same thrill and emotions as you. Can we, so I'm going to do the same trade type of thing. So I guess the question is like, how can you make investing more social, or how do I think that's going to evolve? That could be one thing, which is pretty interesting. There could even just be like, I see indirectly people have investing groups themselves. So it's largely, maybe I have like a group of friends that I went to school with, or maybe I worked with, or like there were other investors that I knew. And we're just going to go and like, we're going to talk, we just have our own text threads, and we're going to like evaluate stocks. And then in the most aggressive case, one of my friends, he's been helping me out a lot. He was actually an On Deck. I met him through On Deck, which is really cool. He was like, so we have this group, and we were all former like private equity or hedge fund people. We're going to make a bet. We're going to try and make this bet together. And if it works, we're going to Vegas, right? And and we're going to celebrate. And it's like, partially it's about returns, but partially it's about like, this is the community and like just the feeling of like belongingness, or doing something with other people. So I'm not sure yet what the solution is, but that's what I'm trying to explore and see if can you make, you know, investing fun and more than just returns.
I mean, we're talking about sort of we started this conversation by talking about how, because we don't have sports, people, you know, need to sort of like bet on something or get excited about something.
Yeah.
And it's interesting to think, like, we have stocks for companies. I've always been curious, are we going to have like, you know, stocks for ideas, or stocks for people, or sort of like different kinds of sort of betting markets? Effectively.
I wonder actually if SPACs might fit your stocks for ideas type of thing, because largely they're a couple years into the future. This is what we're betting on, what we think is going to happen. We're not necessarily having, you know, revenue right now, or a product that we're selling right now. And you're essentially buying into the idea. So I guess SPACs could be one of those things. I know with idea markets, I saw like on, I think I saw like you engaging, there's a couple people who were trying to do this in terms of on a way on like the blockchain, but yeah, I have no idea.
Yeah. I want to go to a website and see like, you know, capitalism down 20% today, or like some idea or some construct, or, you know, just like sentiment analysis, real-time sentiment analysis on things. And the only way you get that is if you have betting markets.
Yeah.
It's different from prediction markets, which are saying, you know, will X or Y happen? You know, will, you know, Biden win president or Trump win president? And then you have a definitive yes or no. Will the sports team win? Whereas idea markets are more just like, are people gonna buy it or sell it?
Gotcha. No, that makes sense. So essentially, like, you're sort of, it's like a second degree you're making the trade on.
Yeah.
Yeah, that'd be cool.
And I think the way to do it is basically to make it a collectible. So like, if I might just, let's say I'm a big fan of capitalism. I might bet on capitalism, one, because I want to be known as someone who supports it, and two, because I might want, and better example for this might be like an artist or a type of music or an intellectual, like SPACmania. You just coined, it's meme market. You coined SPACmania, and you know, you want to be the first person to be known for that. And it's sort of, imagine like Bitcoin, there's like a limited supply, but also it's like public what order buyer you were. Like people get status from being early in Bitcoin, right? Like SPACmania turns into this big thing, you know, and you're or even the term like ICO before it becomes a thing. Like you're like, this is going to be a big trend. I'm going to buy into it first and show that I'm like a tastemaker in that way.
Yeah, no, that's pretty cool. Actually, when you talked about that, it sort of reminds me of Cosign, or at least the On Deck product. But it's like Cosign, but for ideas.
Yes. Long live Cosign. It'll happen. Awesome. My guest today has been Anuj Abrol. If you enjoyed what you heard, definitely sign up for Witty Wealth. Anuj, thank you so much for coming back on the podcast.
Thank you. Anytime. It's witty.substack.com. And feel free to subscribe and reply to any of my emails, and I can talk to you there too.
If you're an early stage entrepreneur, we'd love to hear from you. Check us out at villageglobal.vc.